Hello, I'm Matt Cadnar from the Asset Allocation Team and the NEBO team here at GMO. I'm joined by my colleagues, James Montier and Martin Tarlie, the authors of the white paper for Investing for Retirement. So James joined GMO about a dozen years ago from the sell side. He focuses on macroeconomic research, but he's also a passionate value or valuation-based investor and also an expert in behavioral finance. Martin Tarlie is in his second stint here at GMO. He came back home about 4 years ago, but Martin is a trained physicist with a PhD in condensed theoretical matter, which I think was a Jeopardy topic a couple years ago. But he's also a fundamental investor and an entrepreneur. First, just want to thank you for taking the time to join us today for this webcast, talking about Monte Carlo simulations, the impact that has on portfolios, and generally just the importance of making sure that you're asking the right questions. The vast majority of you were kind enough to fill out the survey results, so I wanted to touch those right off the base. And about 70% of folks have concerns with respect to 70% of folks use Monte Carlo simulations, and about 80% of those folks have concerns about their Monte Carlo results. And so we certainly have some things to say about that. But also a couple of related questions on the single biggest risk your clients face. 60% indicated that shortfall, or as we would define shortfall, not having the financial resources you need when you need them, is a bigger risk than volatility. And then lastly, about 60% of folks struggle to align their portfolios with their client's investment plan. And we certainly have some ideas about how to do that effectively and efficiently as well. But I'm going to start by asking Martin a question. So certainly any field of endeavor, there's always critiques and analysis of that particular field. And certainly finance is no exception to that. But when you think about the Monte Carlo simulations, what led you to pick on or critique Monte Carlo simulations given the vast options that you have here?
Okay, thanks, Matt. Well, the motivation for the white paper is really conversations that we've had over the last 3 years with advisors. And in the course of the conversations, advisors would often tell us, we use Monte Carlo simulations. And our response was, that's really good. And Monte Carlo simulations can be very useful. But there are a number of things that are really important to understand about those Monte Carlo simulations. Number one, what is the engine driving the returns that are being used to actually generate the range of outcomes? It's really important to understand that engine. And one of the aspects of that that's often overlooked is what is the volatility profile, especially as the investment horizon increases? So if you're a long horizon investor, you need to be very sensitive to make sure that you understand that the volatility profile that's implicit in the Monte Carlo that you're using is actually representative of reality. So when we had these conversations with the advisors, the concepts and the topics resonated very strongly. And so we were really motivated to write the white paper to explain in a lot more depth our thoughts on these topics.
So that's a nice segue into James. So James, you've written books on behavioral finance, and a lot of behavioral finance seems to be oriented towards investment decisions and investment decision making. When you think about things like models or Monte Carlo simulations, what behavioral concerns do you have there?
I think at the heart of it is a disturbing lack of ability to really carry out critical thinking. And when I'm not here, I am usually to be found either teaching, training, or competing in the field of Taekwondo. Those photos happen to be my two kids and me competing at the British Championships earlier this year. But I was on a course addressing the idea of teaching Taekwondo to kids. And one of the features that came up was ways of trying to engage people to think more critically. And there is now a well-recognized crisis in our inability to teach people to think critically. And I think above and beyond all, when it comes to behavior, particularly when it comes to Monte Carlo-based simulations, it's really about clinging to irrelevant inputs and assumptions. And we know that in the face of uncertainty, that's exactly what people do. So there's a wonderful study carried out a few years ago by some researchers in Germany, and they wanted to see what happened when they gave a completely irrelevant input into decision making. And so they asked judges to consider sentencing a perpetrator of a reasonably minor crime for a period in jail. And they got them to roll a pair of dice before they made their sentence. Being good psychologists, those dice were, of course, rigged. They were either going to give you 9 in total by 3 and a 6, or they were going to give you 3 in total by a 1 and a 2. What was disturbing was that random roll of the dice seemed to have a significant impact on the judge's sentencing decisions. So in the high anchor environment, they gave them nearly 8 months in jail. In the low anchor environment, they gave them only 5 months in jail. And just in case you're thinking, well, that's fine, that's just German judges, it happens to be true of people who work in finance as well. Good many years ago, I got people to write down the last 4 digits of their telephone number. That was surprisingly hard for a number of people to even carry out. But having done that, what I wanted them to do was to estimate the number of doctors there are in London. Now, I haven't got a clue how many doctors there actually are in London, but what I do know is whatever my answer should be is going to be independent of my telephone number. However, what we found was that those who had telephone numbers that ended in 7000 or higher thought there were, on average, 8,000 doctors in London. And those who had telephone numbers that were 3000 or lower thought there were only around about 4,000 doctors in London. So we know that people absolutely will cling to the most irrelevant of inputs when it comes to trying to make decisions in the face of uncertainty.
Well, that's disconcerting, particularly with respect to our legal system on a lot of different levels there. But I guess we'll leave that for someone else. But it is interesting when we think about anchoring and the idea of things that make you feel more comfortable and using models to make you feel more comfortable. I think anything related to investing, if it increases your comfort, I think that's something that you should be wary or potentially have concerns about. But going back to Martin, as we think about the assumptions for out-of-the-box Monte Carlo simulations, what gives you pause there?
Really, the picture that captures the essence of the issue is on the graph here. So on the graph here, on the vertical axis, we have the volatility of returns, and the horizontal axis is the horizon of those returns. So if we look at the 2 blue lines, the upper lines there, and we start sort of focusing on there, if you look at the 1-year return, you see numbers around 18%. So that's the annualized stock volatility, sort of a long-run average of stock volatility. And it's sort of in that high teens number that we're all used to. Now, what happens if you assume that stock prices follow a random walk, if you look at the 2-year return volatility or 3-year returns, and you look at the volatility of 3-year returns, and you carry that out for asset prices that follow a random walk, you'll see the dashed line. So the volatility profile will follow the dashed line. But when we actually go back and look at the data, what we see is the solid blue line. And what we can see there is that the volatility profile that we've seen historically for stocks rises slower than it does if stock prices followed a random walk. However, if we look at the real return on nominal bonds, you see the opposite behavior. You see that the empirics that we observe for the volatility profile of the real return on bonds actually rises faster than if bond prices followed a random walk. So it looks like the random walk assumption is actually inconsistent with the data. Now,
okay, go ahead.
That's an empirical result. And we are uncomfortable anchoring to an empirical result when in the absence of sort of understanding the underlying mechanism. So it was really important to us, if we were going to incorporate this into real world applications, that we fully understand the mechanism and we're not just really conducting a data mining exercise. So for equities, the mechanism is really straightforward, and it's really tied to the notion that there's a fair value for equities, and the price that you observe is really fluctuating around that fair value, but that fair value provides an anchor. So the mechanism is really illustrated on the right-hand side here. If you have your stock price, the stock price rises above fair value, that means that your realized return increases. But simultaneously with that, when your realized return increases above fair value, your expected return actually falls in anticipation that the price is going to revert back to fair value. This negative relationship between the realized return and the expected return is the fundamental mechanism that leads to the volatility profile that we just saw, where stock volatility rises more slowly than it would if stock prices followed a random walk. However,
I love that. I love that concept, Martin, of the clairvoyant fair value, where Schiller had this idea that if you discounted earnings and dividends from 50 years in the future back to today, you would get a pretty accurate assessment of fair value, and that has a volatility of about 1%. But we have the stock price, what we humans are willing to pay for that incredibly stable stream of earnings and dividends is 17 times more volatile. And so that's why James studied behavioral finance.
Yeah, that's right. And it's that sort of relationship between the price and fair value always being that anchor, and there being this negative relationship between the return and the expected return, that is really the driving mechanism for why stocks are often said in the long run to be less risky. Now, it's not that they're less risky, it's that their volatility profile rises more slowly than it would if they followed a random walk. Now, the bond situation is actually a little more complicated and a little less intuitive, and it actually took us a long time to understand this and to really figure out how to explain it. And one of the issues when you think about a bond is what we really care about is the purchasing power. So the thing that's of utmost importance is the real return on the bond. And when you think about the real return on the bond, what you have to incorporate is the real bond price, which means that you have to incorporate the inflation index. So that's the price level. Now, as we're all experiencing right now, inflation is volatile, and there's an enormous amount of uncertainty in that price level, even though for about 20 or 30 years prior, we had fairly quiet inflation. But inflation can rear its ugly head at almost any time. So it's this inflation component that is really the driving mechanism for the shape of the volatility profile of real bond returns. And the easiest way to understand this is to think about if we get an increase in the inflation price index, what that means is that the real return on the bond actually falls. But at the same time, the expected real return on the bond also falls. So you get this positive relationship between the change in the realized return and the change in the expected return. And it's this positive relationship between those variables that actually causes the volatility profile of the real return on bonds to rise faster than a random walk. This is a counterintuitive behavior because we're normally used to the kind of behavior that we see with stocks. But it was really important for us to understand the mechanisms that are underlying the shape of these volatility profiles.
Now, perhaps it's just me, but sometimes when I hear Martin explain these things, my head starts to spin, and I'm left with that feeling of having dropped one too many LSD tabs at a Grateful Dead concert. But I am actually incredibly interested in understanding why people are still using the random walk assumption. After all, miniskirts, bell-bottom flares, public displays of hirsute chests, pork chop sideburns, and avocado green bathroom suites have all gone, thankfully, the way of the dodo. But somehow the random walk assumption continues to lumber on like some Resident Evil T-virus infected zombie. So why is that the case? Well, I think it ends up that we end up at the place where I started, which is that people simply don't learn to question their assumptions, and they're desperately trying to cling to anything in the face of uncertainty. The debate about how we process information goes back to at least the 16th century in a classic discussion between Spinoza and Descartes. Descartes was arguing that we're essentially rational, and thus understanding and believing were two very different mental processes. That first people acquired new information, then they'd analyze it, and finally they decide whether to believe it or not. Spinoza took a very different view. He claimed that understanding and belief were essentially happening pretty much simultaneously. In other words, people believed what they were hearing or reading without really analyzing it. Now, in a well-crafted series of experiments, Dan Gilbert and his colleagues at Harvard University have shown that sadly we are all too Spinozian. Therefore, we have this habit of just accepting things rather blindly. And it's worth noting that even in academia, a field where, as Max Planck observed, tends to advance one funeral at a time, they've updated their views on return predictability. The consensus in the 70s and early 80s was, to quote John Cochrane, returns were unpredictable like a coin toss. But in his 1999 paper, New Facts in Finance, he states, we now know returns are predictable and volatility changes through time. So if this is so well known, why on earth aren't we doing something about it? So I would argue it's high time that we focused on the potentially apocryphal Keynes quotation, when the facts change, I change my mind. What do you do, sir?
Thank you, James. I do have to say that that might be the ugliest bathroom I've ever seen. I mean, good Lord, did that really happen? So if we understand the empirics, if we understand the mechanism, the intuition behind it, Martin, can you walk through some of the practical implications of it?
Yeah, so what can we do about it? We can start by understanding what impact these modeling assumptions have on the portfolios that you own. So what we have illustrated here, we're using a glide path as a device. So the glide paths here are making a variety of different assumptions. One of the assumptions is we're assuming that all assets are fairly priced. And what that means from an expected return standpoint is that at every period, the expected return is always the same. So stocks are always going to return you approximately 6 real, et cetera. But what we are varying in the graphs here is we are varying the assumption essentially about the volatility profile. So in the upper left-hand corner, we are assuming that both stock expected returns and bond expected returns vary over time using the mechanisms that I outlined earlier, so that you get a stock volatility profile that rises slower than a random walk for stocks, and for bonds rises faster than a random walk. And if you combine that with a portfolio construction framework, which I'm going to discuss in a moment, which essentially frames risk as not having what you need when you need it, you can basically trace out a glide path that for relatively young investors has a high weight in equities. Contrast that with the lower right-hand corner, where we assume that both stock prices and bond prices follow a random walk. The only difference between the glide path in the upper left-hand corner and the glide path in the lower right-hand corner is this assumption about whether or not stock prices follow a random walk. And what you see if you follow the shortfall-based portfolio construction framework, just by changing that assumption, which effectively means that instead of using the empirically consistent volatility profiles, we use the random walk profiles, you get an equity weight for a young investor that's much lower than you would get if you would use a different return assumption. So the key point here is not the particular shape of the glide path or the particular levels at any point in time. It's really the contrast between the different assumptions that you're making. Because the only difference between the upper left and the lower right is this assumption about whether or not stock and bond prices follow a random walk. Now,
Martin, what return assumptions are you using here?
So these are just equilibrium return assumptions, 6% real for stocks, 2.5% real for bonds, and 1.5% real for cash. Now, I mentioned earlier that the motivation for this study, or for actually writing the white paper, were conversations that we've had with advisors. And the reason we've been having conversations with advisors over the last 3 years is we've been building an asset allocation platform for advisors. And it was in the context of the discussions about this larger platform that we had the conversations about Monte Carlo simulations. So I just want to take a minute. What we have on the screen here is we have a screenshot of a page from our web application that actually implements a lot of these ideas. So over the last 3 years, we've spoken and worked with a number of advisors, and we've built an asset allocation platform that really melds financial planning and asset management. And the key idea that it embodies is this sort of big idea that risk is not volatility. Instead, risk is that you don't have the financial resources you need when you need them. This platform is fully open architecture, both from an implementation standpoint, but also from a market view standpoint. So we're well known for our asset class forecasts. We make those forecasts available to you on this platform, but we don't require that you use them. You are free to incorporate other capital market assumptions, your own capital market assumptions, et cetera. The choice is yours. So this platform is really designed to sit between what you're doing on your financial planning side. So if you're using a financial planning tool like eMoney, Money Guide Pro, or something like that, you continue to use that. All of that information feeds into the planning components of this platform. You then use this platform that we call NEBO to essentially do this multi-period shortfall-based optimization that minimizes the risk of your clients not having what you need when you need it, but it's really connecting the financial plan with the actual investment portfolio or the asset allocation decisions. Now, I mentioned that this platform can actually do a lot of things. It can do a lot of things like help streamline your operations because we link into the kinds of models that we use. We don't change your investment schema, for example. So we map your investment schema into a framework that the platform can understand and do its multi-period optimization on. It also has a lot of reporting capabilities to reduce regulatory risk. But to tie it back to the white paper and to Monte Carlo simulations, what the platform allows you to do is to run Monte Carlo simulations using a simulation engine that is consistent with the historical patterns that we see over time, as we illustrated in these volatility profiles. But you can actually turn that on and off. So what I've illustrated in this upper glide path is that glide path was built using the shortfall optimization, assuming that asset prices are actually time varying and they revert back to the mean. In the bottom glide path, we're assuming asset prices follow random walk. So the patterns that you see in the upper glide path and the lower glide path are really what we were looking in the upper left and the lower right on the previous slide. What you can then construct in NEBO is you can run these Monte Carlo simulations and you can actually compare the outcomes. I'm not going to walk you through the details here, but just sort of point out that we have a platform that allows you to investigate and understand and explore all the implications of the kinds of assumptions that you can make. So, for example, some of the things that you can do is you can build a glide path that does not make the assumption that all assets are fairly priced. You can incorporate current market conditions, account for the mean reversion of those expected return, and build a customized glide path for each of your clients, and then run appropriate Monte Carlo simulations to test the viability of a strategic allocation plan.
Thanks, Martin. Thanks, James. So some important behavioral issues that I think we need to be aware of, certainly some important practical considerations with respect to Monte Carlo simulations and really trying to make sure that advisors are well armed and have can translate that into effective portfolios for their clients. As Martin mentioned, we've been working with a handful of early adopters in building this NEBO asset allocation platform. We are expanding that. We're starting to make NEBO more widely available and to a wider audience. So if these ideas around Monte Carlo simulations, the idea that risk is not having the financial resources you need when you need them, the idea of personalizing portfolios based on the unique needs and circumstances of each of your clients and doing that. And I would say that's real personalization based on each client's unique circumstances and doing that in a robust and efficient manner. Please do reach out to us. Contact your relationship manager, email us at access@gmo.com. We have a website, www.nebo-gmo.com. There's materials there. There's case studies. You can also request a demo. You can come by our homes at night and we'll talk your ears off about it as well. So please do reach out if you have any additional questions. We do have a couple questions here and there's still some time left. But James, what are the practical things that we can do as practitioners to protect against anchoring?
So there's an expression in the field of psychology, which is if you cannot debias, then rebias. And I think that's incredibly useful because removing the kind of behavioral biases totally is incredibly hard. You can't just wave a magic wand and turn yourself into Spock from Star Trek, an emotionless actor. Instead, it is better to recognize that we are likely to make behavioral mistakes and then try and turn them to our advantage. When it comes to anchoring, I think that really comes down to learning to focus on the things that really matter. And so that means in this context, things like learning to ask the right questions. What do you need? When do you need it? Being the kind of hallmark of the approach. And really learning to question those assumptions and push deeper than simply accepting a random walk as a baseline kind of state of the world. But it's always going to be baby steps. If you try and change too much in one go, a bit like threatening to diet and go to the gym every January, as everybody does, and it lasts for about a week. And then, by February, everyone's forgotten, they're overeating, they're back to drinking again, and exercise is now just a fond memory. Those kinds of overcommitment to too many sources of change is a problem. So having a framework that you can use and rely on, much as we do the valuation framework internally when we're building our portfolios at GMO, we use that as an anchor. And the same thing, I think, goes in this field too.
Thanks, James. A question here on whether NEBO incorporates GMO's 7-year asset class forecast. Martin, you want to respond to that?
Yeah, sure. NEBO incorporates our asset class forecasts, but does not require that you use them. So it makes it available to you, but it's an open architecture platform, as I said, both from an implementation standpoint. So you keep your investment schema, But from a market view standpoint, we basically make our asset class forecasts available, but in the end, you can blend our forecasts with other capital market assumptions. You can use your own capital market assumptions. It's really completely up to you. But we didn't want to lock anybody in to our particular view of the world. So NEBO is really designed to be a fully open architecture asset allocation platform that really embodies this notion that the primary risk an investor faces is that they don't have the financial resources when they need them. And really, it's all about minimizing that risk.
Great. Thanks, Martin. So we are bumping up on 30 minutes. There's a number of questions that unfortunately we didn't get to. We'll follow up with you afterwards to make sure that we answer any questions. But please do reach out if you have any additional questions. And thank you very much for your time. And we look forward to speaking with you soon.